Okay. So under the net asset of the subsidiary, you need to get to know that there is some things that you should bring on board. Acquisition date or date of acquisition. You need to bring date of acquisition. As a date of the acquisition, what is the net asset of the subsidiary? And also you need to bring the reporting date. At the reporting date, what is the net asset of the subsidiary? Reporting date or date of reporting. So then you bring your currency. So with this, therefore, you can start with your workings. So the first thing that you have to bring here is that you need to go to your equity component. On the financial statement, you can be seeing equity. So under the equity, you'll be seeing something like share capital. Share capital. So your share capital, sometimes your share capital will be given to you. So what that you do is that you might be, let's say, maybe the share capital can be given to you and they will tell you that there is what? There's a per share is being, let's say, the selling price per share will be, let's say, 0.05 pesos. So that one, when you see something like that, be very, very careful. If that it is 1 cedi, it means that, let's say, if there is a share that is 50,000 shares, it means that if that per share is 1 cedi, therefore it will still be 50,000. But in a case where there is, let's say, there is this one that they have, but they have written something like let's say, per share is 0.5. Per share is 0.5. 0.5. So it means that if on the out of your financial statement, you see share capital to be 50,000, to be 50,000 here, to 50,000 here, it means that you can write it. But the issue is that you need to make sure that if that you want to know the number of shares, this one is money. So on your financial statement, the figure you'll be seeing there is be in monetary terms. But if you want to know the number of shares, sometimes when you are doing that of the group structure, when you are doing the group structure, or when you are doing that of the workings 3, that's the goodwill. When you get there, I will still explain this one to you. So if there is the share capital is having, let's say, some figure, you just bring it. But like what I said, concentrate on the figures that responds to the subsidiary. When you are doing the net asset of the subsidiary, don't go and look for any figure under the parent. So let's say if there is any shares here, you just bring it here. And on your financial statement, any figures on your financial statement shows what? Reporting figures. Any figure on your financial statement, it's a reporting figure. So you see, we have date of acquisition and we have date of reporting. So all your financial statement data gives you what? The date of what? Reporting. So let's say you come here, when you write your share capital, you bring your what? The figure here. So the same figure which is on the financial statement, the same thing will come at acquisition. If there is any share premium, the share premium, the same thing at reporting will come to the at acquisition. You bring the same thing here. Then, if that, let's say there is any, if there is return, this one, retain earnings. This part is what that is always confused students. So when it comes to this aspect, it's very, very tactical. So you need to make sure that you are getting it. And when you start solving questions, you get to understand some of the different ways that you can get your retained earnings. You see, in accounting, retained earnings is what? It's an accumulated figure. So retained earnings means that maybe at the end of the year, you have gotten your profit. You have paid your shareholders. Your shareholders, you have paid them dividend. The remaining figure, that is what that you are retaining to what? Continue your what? Your business. So that is the retained what? Amount that you have left over. So it's an accumulated figure. It can be like 10 years amount that you have what? Put aside. So that one is your retained earnings. So the retained earnings is not just a year what figure. You get it? It's not a year figure. So what I will do is that in the statement of financial position, when you go to the subsidiary side, you will see retained earnings. The retained earnings figure that you see there, like I said, that one is reporting. So you have to bring it here. It will come to the reporting. But when it comes to the acquisition, you can't bring the same thing here because this figure is this. Because let's say this figure is 5,000. Is this because in this year or last year, the organization made some profit, and the profit, when they pay some to their shareholders as dividend, the remaining figure they have to come and add it to this 5,000, to a specific figure that was here before this one has become what, 5,000. So it can be like, let's say they made a profit of what, 1,000. So you see that profit in your what, income statement. When you check your income statement at the subsidiary side, you can see that profit for the year, let's say 1,000. So it means that 1,000 was added to this. That 1,000 was added to a specific figure. That's why we are having 5,000 here. So it means that when you subtract that 1,000 from here, it will be what, 4,000. So it means that here is supposed to be 4,000. That one is the retained what, date of acquisition for retained what, earnings. So this 5,000 that we are sitting here will be a reporting figure, and it is an accumulated what, profit that we have added together. So we need to be very, very careful. And like I said, the moment when you start solving some questions, you will get to what, appreciate what I'm trying to say. So you bring your retained earnings and also to add up to this one. So you bring your retained earnings as well. So retained earnings. So we need to check on this. So and also we have something that we call it pre-acquisition profit. Pre-acquisition profit. Pre-acquisition profit. So the pre-acquisition profit comes in whereby before you are going to, let's say, acquire shares in the other company for you to become the parent. The issue is that you were already in operation. So the profit that will be seen in your financial statement, the profit that will be seen in there, in your financial, that's the income statement. That profit, not all the profit was what? From the what? The reporting period or from the post-acquisition. Because let's say you acquired, let's say, Bernard acquired the shares from, let's say, Benjamin. And we see that the post-acquisition period was 6 months. So if that you see a profit for the year in your income statement, that one is the whole year profit. So it means that when Bernard acquired that shares in what, Benjamin was already in trading and he has made some profit. You get it? So you can't bring the whole figure under reporting. So you need to find a percentage based on the post-acquisition period. So it can be like, let's say if that you go to the financial statement and there is, let's say, a profit of 1,000. There's a profit of 1,000, but when you check through this one, Benjamin, let's say, operated the first 6 months before Bernard came in. So you can't say you are taking all the 1,000 to come and add up to the retained earnings. So you need to come and do what? 6/12 of the profit. So this one will be the pre-acquisition profit. And this pre-acquisition profit shouldn't be part of what? The reporting period. So the pre-acquisition profit means that before you acquire the asset or shares in the other company, that other company was already in what? Operation. And that company has already made what, some profit. So therefore, the pre-acquisition profit is supposed to come here. So it will be date of acquisition. So before you acquire the shares from Benjamin or Bernard acquired shares from Benjamin, these shares, the profit of 6 months has already been what? Made. So that's the reason why you bring what? The pre-acquisition what? Profit. Okay. Then if that you want, the full year profit can be, let's say, at the reporting or the other aspect. But let me go into this one. I will solve questions that maybe you will get to understand me proper. So yeah. Then after this, the next thing that we need to bring up is what? We need to bring fair value adjustment. Fair value adjustment. So the fair value adjustment comes in whereby maybe you can see that because we are assessing the net asset of the subsidiary because that we are going to buy it. So we want to assess it. So when let's say we want to check through their books and we got to realize that there is some of the assets which that when you go to the market, the fair value is what? More than what that they have recorded in their books. Therefore, this one makes it what? This one have to tell you that you need to adjust what? The figures in their books. So you need to adjust the figures. So sometimes the asset can be in asset. Let's say the fair value can be, let's say some assets can be excess. Or they can tell you that it is what? Above. You need to take this one serious because any consolidation question that you do, you will see this. So let me read how that the examiner will, let's say, frame it so that you, anytime you see it, you get to know that this is how that is supposed to be. So the examiner can tell you that at the date of acquisition, the fair value of the asset in the subsidiary are equal to the carrying amount. The fair value of the subsidiary are equal to what? The carrying amount, with the exception of an item or a plant and equipment with a fair value above or in excess of. So the examiner has given you a clue that when you are assessing the books, no, you have got to know that there is some of the assets which that maybe the fair value is what? Higher. So when you go to the market, let's say this laptop, if that maybe in the books, the laptop is what they have recorded 5,000 as what a carrying amount. But when you go to the market, it is 6,000. So this one shows that the fair value is what? Higher than the what that we have recorded in what? Our books. Because of that, we need to come and do what? An adjustment so that what? It will tally. So because of this, because it means that in our books, we have undervalued the laptop. Because we have recorded the laptop to be 5,000. Therefore, we need to come and what? Adjust it by bringing it here. Come and add it. We need to come and add it. So it will come under a date of acquisition and also under date of what? Reporting. And because that this is what the excess, we need to what? Find depreciation on it. We need to find depreciation on it. So we need to bring the depreciation. And depreciation is calculated by having your what? Your depreciation is equal to your cost minus your what? Your scrap value or residual value. All divided by the economic useful life of the asset. So economic useful life. So the moment you bring and punch this one on your calculator, you get to know your what? Your depreciation amount. So you bring your depreciation, but the depreciation is supposed to be done on this one. So let's say they will tell you that maybe the asset, the remaining year of the asset, let's say 5 years. So you just have to divide this figure that you have brought here by 5 years. It will give you your depreciation. But you need to be very, very careful because anytime you do this, anytime there is what? The fair value adjustment, the depreciation figure is supposed to be tallied with your post-acquisition period. Assuming based on the workings that we started with Benjamin and what Bernard, the post-acquisition period was 6 months. So if you are doing and you are computing for your depreciation, you need to make sure that you are taking into account the post-acquisition period. So if that, let's say, we are having depreciation, let's say the assets in amount is, let's say, 5,000. So if that the assets is 5,000, you do 5,000, and they are telling you that, let's say, the remaining useful life of the asset is 5 years. So we divide it by 5 years. Then you need to also take into account what? The post-acquisition period, which is 6 months. So this one will give you the depreciation figure, and that, the one that you bring here. So you have to come and what? Subtract it here. You need to come and subtract. That will be the depreciation when it comes to this. So these two figures, the difference between these two figures will go to group statement of financial position. Group statement of financial position. So it will go under group statement of financial. But we know where asset goes. You go to non-current what? Asset. So the difference between these two will go to group statement of financial position. Then also, sometimes you can go and value the asset, and the one in your books will be higher than what? The fair value. So it will be like the fair value is what? Less than what? The one in your books. So it means that you have, let's say, in this case, the laptop in your books is 5,000, but when you go to the market, the price of this laptop is 4,500. So it means that you have what? Overstated what the price of the laptop in your books. So that one too, we call it what? When there is some asset, when the asset is below. So the examiner will tell you that when it is below, let's say the fair value is below the carrying amount. So when it is below, it means that you need to come and what? Subtract it, because the fair value of the asset is no more 5,000, but it's 4,500. So the difference, you need to come and not all that the difference, but what that they will give you, will be the one you need to come and bring here, and you come and subtract it. So you subtract. Unlike in the assets, in the excess, what that we came in to add here, you come and subtract. Then you bring what? Depreciation as well. So the depreciation, the same method, how that we calculated for that depreciation, it will be given to you. The remaining useful life of